Andrew Slimmon is a senior portfolio manager at Morgan Stanley Investment Management. Andrew, what happened in August? How would you sum up that sort of, I don't know, it's disappointing after what we had seen from October through July? Was that just a backing and filling in your view?
Yeah, pretty much. Hey, Joe. Look, I think the fact that the market only pulled back 3% is a sign that positioning still is too negative. And we didn't get more of a pullback than that because even though seasonally August is a weak month, people jumped on that pullback. And really the market has had a pretty strong rally since the third week in August. And so it just tells me positioning remains too negative and people need pullbacks to get better position.
So how would that, number one, what's the economic backdrop or the Fed backdrop for the 10% gain you see before the end of the year? And what does that mean for 2024?
Yeah, look, I'm more worried about 2024 than I am 2023. I just think that we're seeing classic behaviors. This is a textbook case of what happens after a bear market. People get too negative. Fund flows are too negative. And that's symptomatic of an early stage of a recovery. And it takes time until people realize, oh my gosh, I shouldn't have been selling. I should have been buying. And I still think that's out there. Weekly fund flow still remains negative. And I think the return differential between money markets and equities is going to become more acutely painful as we get into the end of the year. And that's the first reason. We get, earnings are going to invert from negative to positive, and you get a huge amount of public work spending coming in the fourth quarter. All that is very positive, and that's why I think you get closer to 5,000. But what worries me, to your question, is we are right now, the monthly year-over-year inflation numbers are coming down, but that's going to get tougher next year. The bar is going to get harder. And at a time when the Fed's still pressing on this 2% goal, I see that as that's going to be a tough thing to overcome. But that's a next year story, 2024, not a 2023. I have a hard time seeing the market substantially sell off, however, with an election year and the amount of stimulus that is coming in the fourth quarter. I don't think this is really discussed enough.
So money market funds will be more attractive next year? There'll be no cuts next year? Interest rates will stay higher for longer?
Well, Joe, you know as well as I do, whatever is the most popular product usually doesn't do well the next year. So how is the money market, the most popular product, not going to do well? Well, if the economy really fell off a cliff and rates came down, that wouldn't be good for money markets, but it would certainly be better than risk assets. It seems to me the way the money market turns out not to be a great investment is we get a slowdown, but not a recession, at least next year, and the stock market hangs in there.